Good afternoon all. Thank you for joining us on today's webinar. I am Nikita Singhal from Webtel, welcoming you to the session on practical case studies for real estate sector. So as we all are living in the era of digitalization, where everything from the simple to complex demands eases with technology, here is why Webtel believes in making IT a way of life. We are India's one of the leading e-compliance companies known for its compliance management, office management, and HR management solutions. We have incorporated a knowledge academy as well, where you can do all your learnings by opting for self-paced courses, staying in line with the blogs, keeping pace with webinars, etc. Today, we are presenting a webinar on practical case studies for real estate sector presented by our renowned speaker, Mr. Tushar Agarwal, sir. So now let me introduce you to our speaker of the day. CA Tushar Agarwal ji is a co-founder of Tattvam Advisors. He has more than 10 years of experience in indirect taxation. He has worked for more than 8 years with Lakshmi Kumaran and Sridhar attorneys. He was also deployed by GST for GST implementation and has worked closely with government officials. He has worked extensively with the Government of India GST in designing GST returns, audits, and other formats. So just a little housekeeping before we get started. If you have any questions during the webinar, please type them into the chat box. We will take the same at the end of the webinar. Now, without further ado, we will turn the time over to our speaker, CA Tushar, sir. Sir, I welcome you.
Thank you so much for the warm welcome. I will be sharing my screen. Akash, can you just disconnect? Thank you. Good evening, friends. In today's session, we will be discussing the practical GST case studies related to the real estate sector. We will also touch base upon the various litigation issues being raised by the department. In fact, in last couple of years, we have seen DGGI, anti-evasion, departmental audits, and various other departments have become very active, and time and again, they have raised various kinds of issues for the real estate sector. So what we will do in this session is to discuss all such practical issues, live case studies, which are being faced by the real estate developers. We will also touch base upon the precautions which the developers have to take in day-to-day practice, which they are following. Since the sector itself is very big and the number of case studies are very huge, so we will divide this entire session into the two parts. First part we will cover today, and then we will have part 2, another session sometime after a couple of weeks. So before we drill down into the practical case studies, let us spend 4 or 5 minutes on discussing the history of indirect tax law and the development of indirect tax law for the real estate sector, and also the relevant provision under the GST for real estate sector. Friends, when I talk about real estate sector, I'm talking about a developer who is constructing a building, a project on a land maybe owned by the developer or maybe acquired under a joint development agreement. So he construct a particular project, sell it to the end customer. We are not talking about contractors or works contractor, etc. We are talking about developer. So the indirect tax, that is service tax, was introduced on these developers for the first time effective 1/7/2010. During that time, a deeming provision was introduced under the service tax law, which provided that whenever a developer is constructing a flat and selling it to the end customer, and if he receives any part of the consideration before obtainment of completion certificate, I repeat, if the developer who is developing a project and selling it to the end customers, if he receives for a particular unit any consideration before obtainment of completion certificate. In such a scenario, there will be a service tax liability on sale of that particular unit. Only in a case where the entire 100% consideration is received after OC, then there will be no service tax. So they had introduced this deeming fiction to introduce the levy of service tax on the developers, effective 1/7/2010, which continued till GST regime. Similarly, we had a Supreme Court judgment in the case of K. Raheja and Larsen and Toubro, which held that whenever developers are selling flats, there are three elements which are involved in sale of flat or unit. First is the service portion on which service tax is payable. Second is the goods portion on which there will be a VAT levy. So in fact, Supreme Court upheld the levy of VAT on sale of VAT during pre-GST regime. So when we talk about pre-GST regime, there was VAT applicable on developers. There was a service tax which was also applicable on developers. And during pre-GST regime, no credit on inputs was allowed to the developer. They could avail credit only of input services. The credit was not allowed for inputs. Now, with effect from 1/7/2017, when GST got introduced in India, they made life little simpler and they opened the doors for input tax credit for the developer. So effective 1/7/2017, sale of residential unit was leviable or sale of commercial unit was leviable to GST at the effective rate of 12%. So my effective rate was 12% and I was eligible to avail full input tax credit on goods as well as services. So whatever I was procuring, I was in a position to avail credit, and on my output, I had to pay effective rate of tax as 12%. However, again, they took a U-turn in April 2019. 1st April 2019, they restructured the entire indirect tax scheme for the real estate developer. And with effective 1st April 2019, they introduced two separate rates. First, for the residential projects, for the residential units, that is effective rate 5% without input tax credit. We will discuss everything in detail in later part of the slides. I'm just giving a snapshot. So effective 1st April 2019, they introduced two different rates. One is for the residential units, that is effective 5% rate with no input tax credit. The input tax, the doors towards the input tax credit, which was opened effective 1/7/2017, has now been closed, and any new project after 1/4/2019, the rate of tax on residential unit is 5% without input tax credit. However, on commercial units, we still have 12% with input tax credit. So this was the brief history of development of indirect tax law on the real estate sector. Coming to, hope my screen is visible to all.
Yes, it is visible.
Right. Now coming to the GST provision, the relevant GST provision. So we will just discuss this relevant because this is the most real estate specific provision which is relevant for all of us. And thereafter, we will drill down into the live case studies and practical issues which developers are facing. Para 5B of Schedule 2, it's a kind of a deeming provision which deem that this particular transaction of sale of unit by the developer is a deemed service. What does it say? Let us read together. Construction of a complex, building, civil structure, or a part thereof, including a complex or building intended for sale to a buyer, wholly or partly, except where the entire consideration has been received after issuance of completion certificate where required by the competent authority, or after its first occupation, whichever is earlier, shall be treated as supply of service. So this is exactly the same, the way it was worded in pre-GST regime also, that is the sale of unit by the developer to the end customer. If he receives any amount, say the worth of the unit is 1 crore rupees. If the customers sign the BBA and give me 5 lakh rupees as advance before OC, then on entire 1 crore rupees, I have to pay GST. However, if I do the booking after obtainment of OC, an entire 1 crore rupees is received after OC date, then no GST is applicable. That is para B. Second is Schedule 3, para 5. Exclusion. This entry covers, Schedule 3 covers the transactions which is neither treated as supply of goods nor supply of services. So what does it cover? It says sale of land and sale of building not covered under GST except which is specifically deemed to be covered under para 5B. So sale of land, no GST is applicable. Very important to note. Sale of building, no GST is applicable. Schedule 3 specifically covered. And if we compare this exclusion with the exclusion which was there in pre-GST regime, the exclusion read as the service, the definition of service specifically excluded transfer of title in immovable property. So the exclusion in service tax was transfer of title in immovable property, whereas the exclusion in GST is sale of land. And there is a big difference because immovable property is wide enough to include tangible immovable property, non-tangible immovable property, development rights, etc. So the exclusion in service tax was wide, whereas the exclusion in GST is narrow. So this is the basic concept which we have to keep in mind. With this in background, let us move towards our first case study. Whenever a developer is developing a project, he may be developing either on a freehold land or on a leasehold land. Say in Noida, years, I build a project and then sell it to the end customer. So the project can be developed on two types of land. When we talk about freehold land, there is no issue. I am the owner of a freehold land. I am developing a project on it, selling it to the end customer. I will pay GST, either 5% or 12%, depending upon residential unit or commercial unit. No issues. However, most important, if I am developing a project on leasehold land, how do I structure my transaction? Because I'm not the owner of the land. So accordingly, I'm not be in a position to sell the land. I can only sublease the land to the end customer. So when the Noida Authority grants me lease, I'm only a lessor I'm only a person who is having the leasehold rights. I'm not a person who is having the ownership rights. I build a project on that leasehold land and then further sell this project to the end customer. So whenever I'm selling a project to the end customer, I cannot sell the land. I can only sublease it to the end customer because I'm not the owner of the land. What about the superstructure? There can be two scenarios. The way I write in my builder buyer agreement, most important. First is I say I am subleasing my superstructure. So I've seen people in areas like Rajasthan, Noida, etc. Whenever they are developing a commercial project, etc., they say that I'm subleasing this entire unit for 99 years along with sublease of land to the end customer. So the way BBA is written, you are subleasing the land and even the superstructure you are subleasing. So if everything is subleased by you, that is for 99 years of land, then your particular transaction will not fall under this para 5B because para 5B covers only those transactions which are intended for sale to the buyer. Sale means as per the Transfer of Property Act that there should be a conveyance registered deed executed for transfer of ownership. So whenever a project is built on a leasehold land and you draft the BBA in a manner which reflects the fact that the developer is actually subleasing for 99 years the project or the unit to the end customer, in such a scenario, you will not be covered under para 5B. And if you are developing a commercial project, you will be subject to charge at the rate of 18% GST. And in fact, I am actually fighting a case for one of the developer on a very same point, wherein the way they had structured their agreement, it was coming out to be a lease agreement. So please take care. We have seen many projects in Delhi, Noida, etc. on leasehold lands. You build it, but the way you draft your BBA, you draft it in a leasing manner, and it will lead to a higher GST rate. Coming to the second option is you write in your BBA that I am selling the superstructure to the customer along with sublease of land. I repeat, what we write on the BBA is that the drafting of the BBA should reflect that the ownership in the superstructure per se is being sold along with sublease of the land. In India, it is possible in case of a leasehold land that the owner of the land can be someone else and the owner of the superstructure can be someone else. This is possible as per the property laws under the India. So if you write in your BBA that I'm selling superstructure to the end customer along with sublease of land, there we can take an argument that what I'm doing is constructing a unit and selling it to the customer along with incidental activity of supply of lease or land. What customer is looking at is an ownership of the constructed unit. It is not the underlying land, which is the intention. Obviously, that will come along with the superstructure, the build-up area. But what customer's perspective is to really look at is that commercial constructed area which he wants to buy. So if your BBA is drafted in a manner wherein you write it that I am selling the superstructure along with sublease of land, then you will get covered under this entry of para 5B, and accordingly 5% and 12% GST will be applicable. So this is the precaution which we all have to take. Moving on to the second case study. What we discussed is that no GST is charged wherein you receive entire consideration after receipt of OC or after first occupation. So what do you mean by first occupation? First occupation is not defined under the GST law. If we see various dictionary meanings, what does it say? One of the dictionary meanings says the action of living in or using a building or other place. An occasion when someone moves into and start using a building. The act or process of taking possession of a place or area. So occupation simply means taking possession of a place or an area. So let me give you an example. I am a developer. I am developing a project. I have not received the completion certificate, but I make 2 or 3 pieces, occupy 2 or 3 units. So I am building 500 units, occupancy certificate not obtained. I have not neither applied, but I made 2-3 family occupied that particular premises. Can I say since first occupation has occurred, therefore any booking after this date will not be liable to GST? The answer is no. I would like to draw your kind attention towards this FAQ, White Circular, issued White Circular number 354/32 2019. It says, though it is not defined in the Act, it is there in the circular, but very relevant. First occupation means first occupation of the project in accordance with the law, rules and regulation of the state or central government or any other authority. So whenever we are talking about first occupation, it has to be the occupation as per the local laws. It's not that I make someone sit and occupy means first occupation has occurred. It has to be as per the laws. Let me give you a practical example in the state of Uttar Pradesh. So whenever you apply for an OC, there are times when you don't receive OC. So there is a proviso to section 15A, very important. Let me read for you. The proviso to section 15A says that it further provides that if completion certificate is not granted and refusal to grant is not intimated within 3 months after the receipt of notice of completion, it shall be deemed that the completion certificate has been granted by the authority. So in this state, if you apply for an OC, apply for a CC, you don't get it within 3 months, then the law provides for a deeming completion certificate based on which you can even start giving occupation to the authority. Similarly, we have seen that RERA authorities passes various order wherein they allow the occupant to take the occupation under a particular project. So only in these scenarios, etc., we can get covered under the phrase of first occupation and no GST will be chargeable thereafter, but not otherwise. Now, moving on to the third case study related to the rate of tax which is applicable on various projects. So I'm talking about the new projects which are executed after 1st April 2019. I'm not going backwards for the benefit of all. They have divided this entire real estate sector into 2 kinds of project. First is RREP, that is residential real estate project. It means a project wherein carpet area of the commercial units or commercial apartment is less than or equal to 15%. That is, if I'm developing a project of 1 lakh square feet, then my carpet area for commercial project should be maximum 15,000 square feet and not more than that. If that is the case, it will qualify as residential real estate project. The other is real estate project, REP. REP means a project other than RREP. That is a project in which the commercial area is either 100% is the commercial area or commercial area is more than 15% of the total area. Say 1 lakh square feet is my total area, 30,000 is commercial, 70,000 is residential, then it will qualify as an REP. However, if commercial area is up to 15,000, then it will be RREP. So there are two kinds of project and accordingly my rate differs. And one important point to be noted is that whenever I'm saying that my total project area should be less than 15% to qualify as an RRIP, this project, it does not mean license-wise project. It means RERA-wise project, the way you take your RERA registration. So in a particular project, RERA registered project, under that RERA, if the total area is 1 lakh square feet, 15,000 should be maximum commercial to qualify as RREP. That is most important to note and not project-wise. So in case of RREP project, my residential, now I will discuss the various kinds of rates which are applicable. In case of RREP project, my residential unit is chargeable to effective rate of 5%. Effectively rate is 7.5%. 100 rupees is the demand note and 1/3 is the land deduction. So effective rates comes out to be 5%. So my residential unit 5%, no ITC. My commercial units in a RREP project, in an RRPEP project, my commercial unit is also chargeable to 5% without credit. So in an RREP project, residential real estate project, whether commercial unit or residential unit, both are chargeable at 5% without input tax credit. However, if there are any affordable unit, then the rate of tax of that affordable unit is 1% without input tax credit. And what do you mean by affordable unit? Affordable unit means a unit wherein the gross amount charged for that particular unit is less than 45 lakhs and the carpet area of that unit should be up to 90 square meter in non-metropolitan cities and up to 60 square meter in metropolitan cities. So let me give you an example. I am a builder. I am developing a project in Gurgaon. There are 500 units and overall the commercial area of the project is less than 15%. It will qualify as RREP. So my 50 units are commercial units. I will charge 5% without ITC. Remaining 450 are residential units. Amongst 450, 425 are residential units non-affordable. I will charge 5% without ITC. And 25% are my small units, affordable units, EWS units. For those units, I will charge 1% GST without ITC. So comparing it with service tax regime, there we had a concept of a project to be an affordable project or a non-affordable project. Here within same project, there may be an affordable unit or a non-affordable unit. Even in a project, you have one affordable unit, you will charge 1% GST. That's most important. Coming to REP, that is a other than RREP project, real estate project, wherein the commercial area is more than 15%. So let me take an example. 1 lakh square feet is my total area. 40,000 is my commercial area. 60,000 is my residential area. In this scenario, on residential area, 5% GST or 1% GST, no ITC. And on commercial area, 40%, you will have 12% GST with input tax credit available. So in fact, what builders have done in GST regime is they also do planning. Suppose there is a big township which I am developing, say a 10 lakh square feet township, in which my commercial area is less than 15%. Say it is only 1 lakh. So 10 lakh is my total area, 1 lakh is my commercial area. If I take a single registration number of the entire 10 lakh square feet area, then I will become RREP if I take a single RERA registration number, in which I will have to charge 5% without ITC on commercial area. Whereas if I take two different registration numbers, RERA registration number, one for the commercial portion, that is one for the 1 lakh square feet area, which is commercial area, and second is for the 9 lakh residential area. In such a situation, for the commercial portion, I will be in a position to charge 12% with ITC available to me. So that's the sort of planning which we all should consider. This condition, this rate of tax of 5% in residential units and 1% for affordable residential units comes with certain conditions. Namely, first we have discussed no ITC is available. Secondly, even this 5% or 1% amount has to be paid in cash. If you have any earlier ITC available with you, you cannot use it. You have to deposit the same in cash only. Third, 80% of your procurement should be from registered dealers. And this condition has to be met financial year wise. So you have to make sure that whatever you are procuring, at least 80% of the procurement should be from the registered dealer. Let me give you a very unique example in this. Generally, developers have a lot of loan in their balance sheet on which they are paying interest to the banks. Under GST, this interest is an exempt service. Please note, the interest charged by the banks from us is an exempt supply. So for the purpose of calculation of this 80% amount, that 80% procurement of goods and services should be from registered builder. Even this interest amount which you are paying to the bank, and please note, all the banks are registered. There is no bank which is not registered. Any interest which you are paying to the bank, it is a service, though an exempt service, still it will be counted for your 80% calculation. So whenever you are doing this calculation of 80% financial year wise, please consider this interest element also. And one important point to be noted is that RCM on cement from unregistered person. If any cement you are purchasing from unregistered person, month-to-month basis, you have to pay under reverse charge mechanism. So these are the conditions attached to this 5% or 1% rate of tax. And the most important condition is no ITC. No ITC means cost to the developer, and hence there is a role of professionals. How to minimize this cost? What should be the strategy for cost optimization? So let me give you an idea. Say I'm a developer, I'm developing an affordable project. I develop an affordable project. There can be two ways of executing this transaction. Way first, I am constructing this project myself. I appoint contractors, I appoint contractors, I appoint architects, I appoint interior designer, I appoint professionals, etc. and construct the building and sell it to the end customer. On sale, my rate of tax is 1% without ITC. On construction, whenever I am giving a works contract, it becomes 12%. On works contract for construction of an affordable project is 12%. So my contractor will charge 12% to me, no credit. Okay. My architect will charge 18% to me. No credit available to me. My interior designer will charge 18% to me. My other professionals, other service providers will charge 18% with me to me. If I procure cement, 28% will become cost because many developers prefer to purchase cement or steel themselves. Everything will become a cost if you are constructing the project yourself. Way second, I float my contractor company. What I do is that I float a new company, and from my developer company, I give a turnkey contract to the contractor company, stating that contractor company, you have to build this entire project for 50 crore rupees. And for works contract, the rate of tax is 12%. So the cost to the developer company in case of floating a new contractor company and awarding a turnkey contract to the contractor company will be 12%. Whereas if the developer company individually constructed, then their effective cost, generally what we have seen based on data, is generally 15-16%. And this 3 to 4% of the project value is a big margin to them. And what contractor company will do is that they will procure interior services, architect services, steel, cement, etc. at 28%, 18%. They will take credit. They will charge output at the rate of 12%. And even if there is an accumulation in the hands of contractor company, still they will be in a position to get the input tax refund. The contractor company can get the input tax refund under the inverted duty structure. So that's a strategy based on actual data, is something which we can consider and float. Moving on to the next case study. Taxability of various kinds of charges which a developer is recovering from the customer. Basic sale price, we have discussed 5%, 1% or 12%, as the case may be. What about preferential location charges? Can anybody write in the chat box what is their view? Whether preferential location charges, is it leviable to 18% GST or is it leviable to the same rate which is applicable on BSP? Just write whether BSP rate or 18% rate. 18%, same rate as BSP, same rate as per AR, 18%, 18%, 18, 18, 18. So I think more than 70-75% people are saying 18% and few of them are saying BSP. So let us understand what is this preferential location charges. In a very simple example, corner plot, sea facing plot, garden facing plot. Is it a service itself or is it a characteristic of a unit or a house which I am selling it to the customer? So can I provide this preferential location services independently of my sale of unit? If I don't sell my unit itself, can I provide these services independently also? The answer is no. To my mind, this preferential location charges, which I recover from the customer, there is no underlying charges or service which I'm providing to the customer. In fact, it's a charge which I'm recovering because of the locational advantage of the unit. So even if we generally see at places around us, if we go for buying a house, 3-corner house generally has more rate, garden facing house has generally more rate. It does not mean that they are providing me a separate service of PLC. Just because an amount is bifurcated and they charge BSP and PLC separate, it does not mean there is two service. Service is only one, that is of sale of flat. It is sale of constructed flat, it is sale of under construction flat, it is sale of corner flat, it is sale of sea viewing flat. So it is the underlying characteristic of the flat which I am selling it, and accordingly the same rate should be applicable, which is applicable on BSP. And in fact, you also pay stamp duty on this, and you pay stamp duty only on those services which are incidental to your construction service, which becomes part of your construction service. Therefore, the same rate will be applicable. But where is the problem? And in fact, there is a favorable judgments also under service tax regime that PLC is a part and parcel of the main service of construction of residential complex, and hence abated value will be available. But where the problem lies? The problem lies is because of the advance rulings, the negative advance rulings, which comes into picture. For example, this particular triple AR, they held that builder is charging an additional amount in the form of professional location charges. Such PLCs are a separate service which has no association with the land, and hence the abatement cannot be available. So because of such rulings, there is a dispute at ground level, but generally, to my mind, it's a very, very good case to say that PLC will be liable to the same rate what is applicable on BSP. Coming to the industry practice, see, whenever we are advising our clients, we have to note three things. First is, what is the legal answer? What is the practical answer? Legal and correct answer as per the law. That is first point. Second point which we have to consider is, what is the department understanding? Because we should not get into disputes every time. So what the stand department is taking. Third is, what is the industry practice? I am not the only developer. There are 100 more developers who are doing this particular transaction, recovering this particular amount. What is their treatment? And based on the legal stand, the industry practice, and the departmental stand, we have to take a commercial call for the client and make sure that they are at a risk-free position. Because there is a big difference between consultancy and litigation. In litigation, you have to defend. A client comes to you stating that I've charged BSP rate on PLC, but department is saying 18%. Simply tell them, very good case, we will win at higher forum. But if someone is coming and asking for an advice, what rate should I charge? He's saying, sir, whatever you will tell, I will recover from the customer today. Down the line, after 5 years, if there is a litigation, it will go out of my pocket. So let me know the stand which I should charge. So that is the commercial perspective also you have to keep in mind while making any decision. So for PLC, my view is it is the same rate as applicable on BSP. Industry practice also is same. 90% of the developers are charging BSP rate only. Moving to say a second type of charges, EDC and IDC charges, internal and external development charges, which are recovered by me and paid to the authority. So there is a big dispute going on whether this EDC, IDC recovery made by me from the customer is GST applicable on this particular EDC and IDC. Under service tax regime, there was a circular issued by the government which stated that any EDC and IDC charges which the developer is recovering from the customer and giving the same back to the authorities, no service tax will be leviable because they are acting in the capacity of pure agent. But no such circular has been issued in GST regime. Further, in advance ruling, there is a negative advance ruling which says that as per section 15, subsection 2, clause A, value of supply shall include any taxes, duties, cesses, fees or charges recovered under any tax laws, recovered under any laws for the time being in force. And therefore, based on this valuation section, the ruling held that EDC, IDC recovered under law will be included for the purpose of GST valuation as per section 15.2, and there is a negative triple AR in the state of Haryana also. And practically, developers are facing a lot of issues from the department also, whether DGGI, whether anti-evasion, whether departmental audits. Everyone has taken a unique stand that GST is payable on this EDC and IDC. If you don't pay, then you have to litigate, you have to face the heat of the department. So my view is that in the initial years, some developers may have taken a call to pay, not to pay, etc. But going forward, at least from this current financial year, please avoid litigation. This matter will not be settled before Supreme Court. Better pay GST on EDC and IDC recovered by you. Moving to other kinds of charges, say car parking charges. So there are two types of car parking, mandatory car parking charges, and someone also collect additional car parking charges. So for the mandatory car parking charges, the same is incidental to the construction services, and these are also included for the purpose of stamp duty valuation, and hence same rate as applicable to BSP will be applied. However, for the additional car parking, what we have seen is that they are generally not included for stamp duty valuation purpose also, not treating it to be a part of construction, and accordingly 18% GST will be applicable. Interest on delayed payment, same rate as applicable on the original consideration, that will apply. Moving on to the next case study is of taxability of plot. MC, I'm a developer. I purchase a bare shell of land. I develop various common amenities, including main gate, roads, sewerage system, gardens, an entire drainage system. I develop the entire bare piece of shell of land into a developed plots and sell these developed plots to the end customer. Do you think GST is leviable on this sale of developed plots? No superstructure is built on the plot. It's a bare shell of plot, but I have developed the common amenities. And now I'm selling this developed plot to the end customer. So I want people to write in the chat box what is their personal view, whether sale of developed plot, should it be leviable to GST? Remember what we have discussed in the starting of the session, two entries. One is sale of land outside GST. Let me again go to that entry because everything resolves around this particular entry only. Sale of land, no GST applicable. Can I say sale of developed plot is sale of land? Schedule 3. Or since I'm building a common infrastructure like road, sewerage system, drainage system, parks, etc. So will it get covered under 5B? Construction of a complex building, civil structure, or a part thereof. So what is the view? No GST in plot sale, no GST. It is not a building. Dilip ji saying yes, GST on development charges. Deepak ji saying GST on development charges, no GST, no. So most of the people are saying no GST, no GST. For the reason that it is a sale of land. Now, practically what is happening? Before we come to, now, I agree with you. When we talk legally and academically, sale of plot, developed plot, no GST. I'm not building a superstructure. I'm not building a building or a complex on it. It's only a bare shell of land, which I'm selling it to the customer along with the right to use the common areas. So I will get covered under sale of schedule 3 only as sale of land, and no GST should be applicable on this. Sale of developed plot, no GST applicable. We both are on the same page. But what is the practical challenge which we are facing at ground level? Whenever we are launching a new project, etc. In last 1 year, we have seen so many DJI teams, anti-evasion teams, they visit and they always try to extract and force the developer to pay GST on sale of developed plot. They are saying is that I am doing a service to the end customer by developing this common infrastructure. So entire infrastructure which I have developed, they are using it, and because of this only the plots have become habitual for residential purpose, and accordingly there is a service element of construction of common amenities and GST should be payable, and they demand 18% GST, etc., etc. So there is a huge litigation which is going on, and when we see the advanced rulings and the judgments, we have both kinds of judgments, positive judgments as well as negative judgment. Say I will one of the negative judgment. What does it say? Sale of developed plot is not equivalent to sale of land, but is a different transaction. Sale of such plotted development tantamount to rendering of services, and hence GST is payable. Negative judgment. When we talk about positive judgment, they say the reason why there is a positive judgment. What is the reason? A very beautiful and a correct reason. In the instant case, the entry 5B, what we discussed, cannot be applied as these roads, poles, or drainages are not for sale to probable buyers of plot. Neither their ownership nor their exclusive possession shall be passed on to the probable buyers of the plot. Rather, these are intended to be eventually vested with the local authorities. The principal transaction is of sale of land, and these amenities are natural part of the sale of plot of land, and hence no GST is payable on this particular transaction. A very correct judgment. But considering the fact that at ground level you have positive judgment as well as negative judgments also. We have 3-4 positive judgments, few negative judgments. both kinds of judgments are there, and the department has taken a stand that they are asking for GST on this particular transaction also. What is the practical approach which we are suggesting to the client? See, at most, the risk is only on the common development, common amenities which you are developing. That is only the service element which can actually be taxed, not the entire sale of land. So what we are telling our client is that whenever they enter into a BBA, just write development charges separately. For example, you have to recover 1 crore for this particular piece of land. So in the consideration clause, write a bifurcation of 1 crore that I'm selling this plot for 1 crore rupees to the end customer, and the bifurcation of 1 crore rupees is 90 lakh rupees BSP for the plot, 10 lakh rupees as development charges. And on these development charges, better pay 18% GST, and this will result into a big piece for the developers henceforth. They cannot afford surprise element, department coming and demanding 18% on the entire value. Better bifurcate this value in your consideration clause in the BBA which you enter with the developer and pay on the development charges. That is the most reasonable and safest approach which one should follow, and practically developers have started moving towards this approach. For the past, very good case to say that no tax is payable. Moving towards the next set of transaction is lease of plots for 99 years. So say in Noida, I'm selling plot. It's a sale transaction for 99 years lease. So the ownership is never transferred. It always remain a lease only, whether 999 years or 999 years. What is the GST impact on such kind of transaction? Can I say it is a sale of plot? So 99-year lease, can it get covered under Schedule 3? We read in Schedule 3, sale of land is excluded from GST. No GST on sale of land. Now in Noida, I'm a developer, I'm selling this plot. How do I sell? I cannot sell, I'm not the owner of the land. Noida authority has given me on lease, so I sublease this land for 99 years. So this sublease of 99 years lands, say in Noida or any other region, is it excluded under Schedule 3 or GST should be leviable? What is your view? I want audience to write in the chat box. And write as per the law. Don't write what should be logical. Write if you have to contest this matter. And the Schedule 3 entry says sale of land is only excluded. Under GST, every transaction is leviable to GST. What is excluded is sale of land. Can I say that this 99-year of lease is a sale of land? Is GST leviable or not? Sahil ji saying GST is leviable. GST is leviable. Jitesh ji is also saying Anmol ji. Because, and the reason seems is simply, 99-year lease is still a lease. When you transfer the land for 99-year lease, you are a land. See, what do you mean by an ownership of a land? A land consists of bundle of rights. Right to possess, right to own, right to ownership, right to utilize the benefits of the land, etc. Whenever I am transferring a land for a 99-year lease, what at best I'm giving is a leasehold rights to the recipient. The ownership rights still remain with me. I repeat, the ownership rights still remain with me. And under Schedule 3, what is written is sale of land. And sale of land as per Section 54 of the Transfer of Property specifically means that ownership in the land should get transferred. And since ownership in the land is not getting transferred, there will be practically a challenge on such kinds of transaction, and there will be a GST exposure. So just see the irony. If I am selling a plot in Gurgaon, there is no GST. At best, development charges, I pay GST on the development charges. On the BSP, no GST because it's a freehold land. If I'm selling land in Noida, will it become taxable because 18% GST will be levied as it's a land? CREDAI has given multiple representations on this particular issue to the authority also. In fact, GST law committee is also aware about such kind of anomaly which is there in the law, and we hope that governments come out with certain solution. But practically what we have seen at ground level, nobody is discharging GST generally in these kinds of transactions. Now for litigation, so this is a consultancy view. Generally GST is leviable on such transactions. You have to make developers say, make them aware that there is a GST exposure. But practically what we have seen is that they will always take a stand not to pay GST on such transaction. Otherwise the transaction will become unviable. In such a situation, you have to litigate the matter. And when you litigate the matter, you have to think out of the box. And there you have to apply the principle of what do you mean by sale? From where do I take the definition of sale? Can I say 99 year is a sale? Sale has a bigger term, and when all the rights are absolute getting transferred, then the narrower meaning has to be given under Schedule 3, and accordingly, no tax should be leviable. So various kinds of other arguments have to be developed, and we have to see in future how court will pay attention to these kinds of arguments. So it's a very problematic area being faced by the developers these days. Moving on to the next major transaction and issue being faced by the developer is cancellation of units. So whenever I cancel, let me take an example. I have booked a unit in 2017, raised demand in 17, 18, 18, 19 till 21, 22. Now in May 2022, the customer is cancelling the unit. What should I do? So if they are cancelling the unit, I have already raised the demand note and discharged GST on that demand note which I have raised on the customer. What should I do now? On the demand notes which are raised in 21, 22, you can still issue a credit note because it is within the time limit. So for the demand note raised for the financial year 21, 22, that time limit for issuance of credit note is till September 2022. It is proposed to be postponed till November 2022, but we are waiting for the final approval, etc. So till then it is September 2022, credit note can be issued and GST adjustment can be taken. What about the previous period, 17, 18 till 2021? Under sections 54, you can apply for refund, but refund can be obtained only up to 2 years from the date of payment. You have paid payment in 17, 18, 18, 19, 19, 20. Everything is time barred. At best, you can apply refund for 2021 only. That is within 2 years. And that refund is also subject matter of unjust enrichment. You have to return money to the customer first and then retain this amount and then claim refund, etc. So that's the practical issue. So what about the initial first 3 years GST? It is practically gone. You can't recover from the customer. The customer has paid to you. You have paid to the department. You cannot recover from the department. You don't give it back to the customer. So ultimately, it's the loss of the customer, and developers faces lots of practical pressure from the customers to return this money to them. So in these practical situations, one of the way out is, though very hardly few developers are actually relying upon these kinds of judgment, but most of the developers, they don't return the GST amount to the customer, and they say, since it's already deposited with the government, I cannot go for refund, so the chapter is closed. But if somebody wants to go for refund and there are commercial reasons wherein the developer has to return money to the customer, etc., then they can rely upon these judgments wherein, and there is a recent tribunal judgment also which have held that this time limit of 1 year in service tax regime or 2 years in GST regime has to be counted from the date of cancellation of unit and not payment of GST. So cancelled unit, the cancellation even took place in May 2022. See, the cancellation took place in May 2022. This time period has to be calculated from May 2022 because at this date only I came to know that the unit is cancelled and the cause of action occurred. I repeat, the cause of action occurred right now. Accordingly, relying upon these judgments, if you have reimbursed the GST amount to the customer, you can claim and file refund stating that the time limit has not lapsed, relying upon all these judgments. Another important issue being faced by the developers is the GST rate on the cancellation charges. So whenever a customer cancels the unit, say he has given a demand note of, you have raised a demand note of 100 rupees, he have paid 100 rupees to you, you have discharged GST on 100 rupees, say 5%. Now they have cancelled, you have returned 80 rupees to the customer. Remaining 20 rupees is left, and you are forfeiting that 20 rupees as cancellation charge, as forfeiture charge. Department is arguing that on this 20 rupees, please pay 18%. What you have paid is only 5%, that too on account of construction services. But when you retain this 20 rupees, it becomes and takes the color of a different transaction of agreeing to the obligation to tolerate an act, and accordingly such forfeiture amounts, such cancellation charges are subject matter of GST at the rate of 18%. So they cover under developers, and they raise issue that the developers are covered under Schedule 3 entry 5E, and all these cancellation charges are covered under this entry, agreeing to the obligation to refrain from an act or to tolerate an act or a situation or to do an act. Now, on this particular subject matter, taxability of liquidated damages, cancellation charges, forfeiture charges, compensation, penalty, whatever name you say, notice pay, etc., numerous judgments have come. In service tax, we only have positive judgment and not even a single negative judgment. Most important, Navalu Lignite, Steel Authority, Southern Eastern Coalfield, Repco Home, you take any judgment, all positive judgments under service tax regime. Not even a single negative judgment. And the reason is that there is no underlying service. It is only in the nature of penalty. It is not that I'm tolerating an act. It has to be a positive service. Here, rather, I have not tolerated and hence imposed a penalty. So there is no service element. There is no quid pro quo of an underlying service for which I'm agreeing and casting a consideration. There has to be a positive act. And on this premise, series of positive judgment that no tax is payable, no service tax is payable on all these elements. In GST, we have both kinds of rulings. Earlier, we had only negative advance ruling, but lately, now few positive rulings have also come that no tax is leviable on these transactions relying upon service tax judgment. So, if we summarize, service tax, only positive judgments, no tax is leviable. That too at C-state level. GST, different kinds of advance rulings, positive advance rulings and negative advance rulings. That too, advance rulings are petitioner specific. And when we talk about foreign rulings, there are series of foreign favorable rulings that no tax is leviable on such kind of transaction. So to my mind, on these forfeiture clause cancellation charges retained by the developer, no 18% is leviable. Tax already stand paid is sufficient enough and no differential tax is required to be paid. Most important, very important, some of the key precautions which you have to take while filing returns. Or the first is, generally, whenever we talk about the real estate sector, it's a very unique sector. See, GST is payable on basis of advance received or raising of demand note. So as soon as you raise demand note, you have to pay GST, reported in the GST return. And from where you raise a demand note, you raise it through your CRM software. There is a billing software, CRM software. You raise it from there. Accounting is altogether different. In real estate sector, accounting is as per percentage completion method or completion method. And accordingly, your returns and accounting revenue will never match because accounting is based on your accounting standards, whereas GST is based on time of supply provision, based on raising of bills, etc. So the most important point which you have to note is that always reconcile your GST returns with your CRM software. If in CRM, what we have practically seen is that people raise demand notes in CRM, but they don't pay GST, they pay GST on receipt basis. Very big issue being faced by developers across India. So always ensure that your data in GST returns always match with the GST data in the CRM software, your billing data in the CRM software. That is the first. Second is under accounting. Since revenue is recognized on different principle, you cannot on monthly basis match the revenue. So what you have to do is that from accounting perspective, always match the tax liability ledger under the accounts with the tax liability as per your GST returns. So that is an important precaution which you have to take. And apart from that, please ensure proper depiction of the demand note in the returns. See, if your demand note is of 100 rupees and you are selling a commercial project. So right, my invoice value is 100, 1/3 is the land abatement, 66.66 is my taxable value, GST rate is 18%, and my tax amount is 12 rupees. That should be my mode of representation in the demand note as well as the returns. And another important area to be noted is what I've seen few developers, what they do is that this 1/3 amount, say, yeah, they are selling a unit of 100 rupees, demand note of 100 units. Taxable value is 2/3, 66 rupees, 18% GST. Remaining 33, they show under exempt turnover. This is not exempt turnover 1/3. It is an abatement given to you. It is not exempt turnover. Please don't show it under your exempt turnover clause. With this, I think we are over with 1 hour, today's time limit, and we have covered most of the case studies related to the output supply. What we will do is that we will have a separate session wherein we will be covering case studies related to the input tax credit pertaining to the developers and case studies related to the development agreement. When we talk about development agreement, commercial development agreement for a commercial project, residential project, plotted project, area sharing, revenue sharing, all sorts of types of arrangements which are being done, we will be covering under a different session. And we will also look at the big problem of reversals under unsold unit, retention money problem, how to cost optimize ITC in case of leasing, constructing a project and leasing the project. So this all we will be discussing in our second session. Now we can take up various queries of the participants. First issue is tax invoice compulsory required to be issued? The answer is, like, whenever we are raising a, generally practically what happens and what we have seen is that whenever you're recovering tax from the customer, you have to raise a tax invoice. So generally they issue a demand come tax invoice. There is a demand note which is generated and it carries all the particulars which are required to be there for the tax invoice. So generally we have seen it's a demand come tax invoice which are generated by the developers for the customer. Can accumulated ITC of RREP be utilized in commercial project at 12%? The answer is no. You cannot utilize this ITC. In fact, you cannot avail this ITC. If you are developing an RREP project, that is residential real estate project, wherein commercial area is less than 15% for the benefit of all, 5% GST is applicable, no ITC. And in fact, that no ITC, you have to show it under ineligible column also. So that ineligible, there is a column under the GST 3B, ineligible ITC. You have to show that ITC amount there. So there is no question of utilizing it towards 12% project. Now coming to other issues. If all the residential units in a RREP are sold only after receipt of completion certificate, then also is it required to maintain 80-24 ratio for RCM purpose. So the question raised is that I am developing a project, residential real estate project. I have sold 100% unit after OC. So still I have to follow that 80:20 ratio on procurement, that 80% procurement should be from the registered vendor. Otherwise I will have to pay under reverse charge. The answer is no. Since your entire units are sold after OC, in such a situation, you don't have to charge GST. And since you are not claiming the benefit of 5% GST, the condition of 80:20 is not required to be satisfied. This condition is required to be satisfied only if you're claiming a benefit of 5% GST rate. If you're not claiming that benefit of 5% GST rate, you are not required to follow this, satisfy this particular condition. Is bill of supply required to be issued for the purpose of sale of plot or sale of unit after OC? See, we generally have advised our clients to better issue a bill of supply. See, sale of unit per se is not a supply of service itself. It's neither a supply. As per Schedule 3, it's neither a sale of land, it's neither a supply of goods nor a supply of services. It is outside the definition of supply, outside the concept of GST law itself, and accordingly you may argue bill of supply is not required to be raised, but as a matter of precaution we have told the clients to raise bill of supply to be on a safer side. GST applicable on subsequent sale. So again, it's a very good issue being raised. I as a individual book a unit in DLF, say the worth of the unit is 1 crore rupees and I pay an initial token money of 20 lakhs to the developer. Now they execute a BBA in my name. Now before obtainment of completion certificate, now I want to transfer this unit to somebody else. Now there is a client, there is my friend who wants to purchase this unit from me. So what he's saying that since I have paid 20 lakh rupees to the developer, he will pay 20 lakhs to me. He will give me a 10 lakh rupees premium also. That is in totality 30 lakhs to me, and remaining 80 lakhs he will pay directly to the developer and the unit can get shifted in his name. This BBA agreement can get endorsed in his name. In such a situation, the 10 lakh rupees which I have earned over and above, is GST leviable to this transaction? It depends upon the nature of the person who is executing this transaction. If as an individual I am executing this transaction in my personal capacity, then I can argue no GST is leviable because it's a personal transaction, like I am selling my old jewelry, etc. However, a company is doing this transaction, then it's like a broker. There is a Supreme Court judgment in the case of Suraj Lamp. It says the ownership of the sale and purchase of the immovable property can only be through a conveyance deed. Otherwise, it is never a sale purchase through a power of attorney, etc. So in this example, we have seen various companies, they underwrite units, say at 5,000 rupees, sell it at 7,000 rupees. This differential of 2,000, GST will be payable at 18% because you will be acting as an intermediary. However, if you're doing this transaction as an individual, no GST payable. We will be sharing the PPT also, and all issues related to the joint development agreements we will be taking up in the second session when we will cover this topic. In case of 80-20 calculation, whether interest paid to the unsecured lender partner is included. If your unsecured lender partner is GST registered, then it will be included. Otherwise, it will not be included. So it's a good issue if the agreement do not provide who will pay GST, whether the developer or customer. In such cases, who is liable to pay GST, whether it can be demanded from the customer. See, there are various jurisprudence on this, and I'm not getting into all those detailed jurisprudence. But if I tell at a broader level, the crux of this jurisprudence, if at the time of agreement, the levy was already there, I repeat, if at the time of entering into the agreement, the levy was already there, then you cannot demand indirect taxes separately from the customer unless you write it. It will be treated to be included and as a part of your normal price, which you are charging from the customer. However, if there is an indirect tax levy subsequent to the point of entering into an agreement with the customer, say you entered into a customer agreement today, and down the line, the GST rate changed from 5% say to 18%. In such a situation, there is a good case to argue that since there is a change in law and there is an increase in GST rate, I should be in a position to recover the same from the customer, being an indirect tax law, the benefit of which has to be borne by the end customer. However, if at the time of entering into an agreement itself, if the levy was there, then you cannot take such position. Again, interest is an exempt supplier thing is not directly taxable, then how the same can be taxed? See, what we are saying is that you have to procure 80% of the procurement from a registered vendor. Only those which you procure from unregistered vendor, you will have to pay under reverse charge mechanism. So for 80% inclusion, for 80% calculation, you have to include interest amount which you are paying to a registered vendor. It is not that if you are paying any amount to an unregistered vendor, that will be charged under reverse charge. That will not be covered under reverse charge. It's only that for 80%, it's a benefit to you that for 80% calculation also include this amount which you are paying to a registered vendor. 20 lakhs, another issue is that the example which I took, that I booked a unit in DLF for 20 lakhs, sold this unit to my customer for 30 lakhs. I earned a premium of 10 lakhs, and then my friend will be paying the remaining amount to the DLF. On 10 lakhs, we discussed 18% GST. I'm not an individual. If it is a personal transaction, no GST. 20 lakhs, there will be no GST. It's just a reimbursement. What I have paid back. Sale of flats. Yes, if it's a registered broker, then it will be counted under the registered head. If it is unregistered broker, it will be counted as purchases from unregistered person. There is in case of a plot purchased by 3 partners and individual name, they want to launch residential plus commercial project. How to structure this transaction? So it's a big issue. It depends upon where the land is located, what is the arrangement, and thereafter whether you have to go for area sharing, revenue sharing, whether you have to form a partnership firm, LLP, a separate company, or a joint development agreement, etc. There are various issues being involved, so it cannot be answered so easily.
Sir, I think we have taken most of the issues.
Right.
Yeah, so do we need to take like more questions or?
I think we have taken most of the issues, and if there are any issues which are left, we will specifically answer it on email.
Okay. So thank you so much because we are already
Right.
over the time. Yeah. So thank you so much, Tushar sir, for such an insightful session. I think the topic which we have discussed today is very informative, and generally we are confused about these provisions. So thank you so much, and we will be covering the half part as sir told you in the next session, and the date and timings of that session will be shared with you separately very soon. So thank you everybody for joining this session, and PPT also we will be sharing with you on your registered mail ID.
Thank
So
you.
that's all. Thank you.
Thank you, Nikita. Thank you, everyone. Thank you, organizers, and thank you, audience, for the patient listening. And the questions asked was really, really good. And we look forward for the second session soon.
Okay.
Thank you. Thank you, everyone.